Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in, take a look, see what people are sharing. If you want to follow me at _finance, if you want to join our community, finding-value.com, I dive deeper into these topics, looking for potential investment opportunities for everyone in the community. I also share my opinions on how to approach the markets, my opinions on portfolios, portfolio allocation, all of those things for this commodity bull market that is coming up and we are in. We do have a special coupon code. Special is the code if you'd like to try it out and join. Starting with myself, long-term platinum to gold ratio, and my awesome recreated one. So this is data that I had found on the internet with the ratio going back to the 1800s, 1880 all the way till 2016-ish on this chart. You've got the three hump consolidation, 1, 2, and 3. And then what I did is I added this chart onto more recent data. So this is the big consolidation there from the 1800s. Now, why is it such a big deal? Why do I care about this? People are going to say, well, this ratio has been compressing. It's really low. It's a bad investment. Well, we don't invest based off of history, so to speak. So what people do, what a lot of people do, is they look at the trend before and they'll say, well, that trend's going to continue. And that will be a good investment because the trend will continue to infinity, is what they think. What I do is I like to buy patterns. So we've got a ratio back in the 1920s during Weimar Germany that was up around 5.5. So that means that platinum was 5.5 times the price of gold. Or other words speaking, 1 ounce of platinum could buy 5.5 ounces of gold during Weimar Germany, that hyperinflation. We went all the way down to a very low amount on a 1-to-1 basis from the 30s and 40s. Then we went back up all the way till 1970. Gold became freely traded around this time, and it got revalued back to about a 1-to-1 relationship. If you look at where we are today, this is that awesome recreation of me just throwing it in real quick, trying to get it somewhat close to history. There we are. We're at the bottom of where it was all the way back in the 1800s. Are we going to break to the upside? Is this a false breakdown of this three-hump consolidation? My guess is yes. Could I be wrong? Well, anyone can be wrong when it comes to this stuff, but you've got the valuation of platinum being cheap against gold on your side for a revaluation higher. And that's about all you get in the markets. You don't get certainties. What you get are probabilities. So if I were to take this chart here, and I've got, this is platinum. This is just platinum priced in dollars. It's squeezing up into the corner here. Squeeze, 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 squeeze. So we've got the three-hump consolidation. We broke out of that consolidation, and then we squeezed again after this in another kind of three-hump consolidation. We are squeezing, and we've got a similar setup to this setup right back here. It's a very similar setup. But if we were to go to a platinum to gold ratio, this is the ratio that I had my awesome recreation on that I kind of tried to fit it in there. So there's the awesome recreation that I had to put in there to recreate what you guys were looking at. What I like to do, if I were to create a chart that said, okay, let's put the amount of times that the ratio has been here, you get a chart that would, if I can draw this correctly, you get a chart that looks something like this, like a normal distribution curve. This is a low ratio on the tail. This is a high ratio up at like this area up here. So this here could be maybe 5.5, and then this tail down here is anything below 1.0. And we're at 0.3, and there's only like 2 times in history that might have been at 0.3. So it's about reverting to the mean. So some would say, well, this is traded down for so long, I don't believe in it. What I'm saying is I can buy an asset that's valuation has really never been cheaper in history. Think about that for a second and think about your risk reward levels. If you can buy things that are underneath the cost curve, which it is, and you can buy it on a tail of a normally distributed curve like that, isn't that kind of like the best thing that you can do from a valuation standpoint? Is there anything in the market that can get better than that? I mean, crude oil is in a similar situation, but platinum's also in that similar situation as crude. So they're very similar in their setups. This is the long-term silver to gold ratio, and it's squeezing up perhaps. Interesting view when you look at it from a long-term perspective. Another interesting thing, you saw the 3-hump consolidation on platinum to gold. If we were to take this ratio, let's do it real quick. XAG USD divided by XAU USD, and that gets me the history that we've got in this. We're squeezing up into this corner here, which I find very interesting. There's got to be reasons and explanations for this. This started in 1968, the peak of this ratio, or the peak of silver versus gold, and we do understand that gold was being controlled for part of this, and then we had a revaluation of gold all the way back down. But we were squeezing into this corner. I cut off the tips of some of these and went off kind of the closing points of all these guys in here. But whenever you get a squeeze over a long period of time, and you get this big 3-hump consolidation in there, and then you get the dead period, it seems to almost always happen. This ratio could reverse and really reverse hard to the upside possibility. Now, again, markets, we don't know for sure with 100% certainties. What we're looking at is it's interesting to see that we're squeezing in this ratio of silver to gold ratio. I just flipped the ratio around. We're squeezing into this corner, and I'm looking for a potential break. If we get a break, maybe silver outperforms gold dramatically. If it were to go back to the highs up here, and I don't know if it will, but let's just see what the return could be or the outperformance against gold. So we're going to go from where we are. I'm taking this dotted line here all the way up. It means that silver would be levered to gold at about 5.7 times, which is a huge outperformance. And then if you go and you look at the long-term silver chart, and you back out, put on logarithmic here. This is long-term silver there. You've got a double bottom here. You've got another double bottom here. And it's this fractal that repeats over and over. You've got another double bottom right here. And we're just starting to come out of that double bottom. So if I were to guess at where we're located, we're kind of like here, if that makes sense. Or we're kind of like right there, perhaps. Just above it, like in here, as we come on up. If I were to take this and let's say, okay, let's try to recreate this move here. That is that. Perhaps, maybe, no, I'm going to do this. I'm going to do it and put it up here and then squeeze it downward. And we got to go upward again to get a little bit more juice in this curve. So maybe it's something like that. And then we squeeze it a little bit more up. So that's the fractal overlaid on top of it. Something on the lines of that is what could occur. Maybe we go to multi-$100 silver here, and we're right in the middle of that move. So that's the fractal that I grabbed from back here. I just squeezed it up a little bit and tried to fit it in there. You can see this one fits right there. And if it mimicked the previous bull market here, we would have gone up to $150 or something. But we only went to about 50. So it's not perfect, but that's the fractal that I think is coming. We have a big move ahead of us in silver, priced in US dollars. So it'd be interesting to see this thing break too. I'm just sharing this again because we were just looking at silver and this potential move and breakout of everything. It says there's still a bit of a time to get off the dance floor and jump into lifeboats. And this is that cup and handle breakout, cup and handle breakout. This is Weimar, Germany, and this is United States of America. If this happens and this unwinds, I mean, silver could be a really good investment. And also, if this unwinds too, if this unwinds to the upside, now there's no guarantee that it will, but I'm positioned for it in case it does happen for both of these. And I'm positioning gold too. So this is kind of scary to me. It's scary because when this breaks out, if we run like this, guys, like when do you panic and when do you really go out and buy the things that are needed in life? And I'm sure doing it now is probably better than doing it later. You know what they say, it's always best to be first. So might as well panic buy first, right? But yeah, I'm kind of already positioned for all this, but I'm still kind of looking at this like, man, this could go up a lot. So it's still a little bit scary, to me at least. Casper says, that's one big green candle. This is the Sprott Physical Silver Trust, PSLV. Quarterly chart, does anything stand out? Look at the volume on this. My Lord, that's gigantic volume on this candlestick here. Or this would be the past 3 months. This is a 3-month candlestick chart. So huge volume entering PSLV. Is there going to be a fight going on here? I heard that PSLV is being shorted heavily so that people don't run into it and PSLV has to buy the physical. It would cause maybe potentially a run on the physical markets. So they're shorting the crap out of PSLV so they don't get to buy more physical, I guess. I don't know. It's the games that are being played here, ridiculous. Part-time trader, don't worry, not far to go now. So this is Bitcoin. And Bitcoin has hit major resistance and it's printing a bearish engulfing 2-week candle alongside a huge bearish diversion in the relative strength indicator. I believe global recession and the return of inflation will drive the crypto market lower than anyone can imagine. ETH will get hit even harder. So he's thinking that this is going to be a squeeze up and a breakdown in Bitcoin and potentially, I would guess, all cryptocurrencies. So he thinks a global recession and return of inflation. So I think that would be like massive stagflation, perhaps. Perhaps that's the case. In fact, I think the alt market will get blown apart. Just as confidence in alt season grows, Ethereum Bitcoin has not been able to sustain a move higher for 4 years now, and I believe more pain is ahead. So what he's using is the ratio. He's using the more sensitive Ethereum versus Bitcoin. And since it's declining, Ethereum is closer to altcoins, so we're not in season for altcoins, I think is what he is basically stating. Yeah, pretty much everything looks bearish here. Nick says, so just to recap, global inventories are low. He's talking about oil. We have draws during the build season, which is incredibly bullish. China is destocking inventory as well, and yet bears would have us believe that the outlook is bearish for oil. So Chinese crude oil inventories have drawn year to date as refinery runs hit all-time highs for the January-February period. I've been pounding the table that Chinese destocking is not normal. Soon this will swing back to restocking to fill the storage they keep building. So you can see China available crude and refinery runs. They've been coming back a little bit here recently. Chinese crude oil storage capacity is continuing to go up, and they're trying to fill it, which is the smart thing to do. You want to fill it and have a bunch of strategic petroleum reserves if you think a problem is coming, which I think they do. WTI crude oil is extremely cheap versus gold. This is the ratio going back all the way to 1983. Cheap is 0.04, and we are underneath 0.04. We're at 0.03 or 0.02. We did hit an incredibly very low level in 2020 where oil went negative, but shoulder, head, shoulder, and on the right-hand shoulder, I'd like to see this move on up. We also have a squeeze here coming down in a falling wedge, which is a bullish formation to go higher. So I am a bull in crude oil with the ratio where it's at. This is the second or third cheapest time in history to ever buy oil, going back to the 1800s. It's one of the top cheapest times in history. Does that mean it will turn and go up immediately? It doesn't mean that. But what if I collect a portfolio where I buy all these different assets at tail end prices, and I just sit in them and wait for the market conditions to come? You can do this in multiple assets. You just sit, wait for the conditions to change. Everyone, it seems like, thinks that oil is a bad investment down here. That is the current sentiment. That is generally when you want to purchase something. They're going to tell me that a recession is coming and that it's going to get cheaper and that oil is going to get hit. And I can't say that I'm not going to disagree. That's a total possibility that could potentially happen. But what if I purchased a whole bunch in 2020? What if I purchased a bunch in 2016? What if I purchased a bunch now? What if I purchased a whole bunch in the bottom of 2009, a whole bunch in the bottom of 1999, down here in 1994? And what about here in the 80s? Would each one of these times been a good time to purchase oil if you had held for a period of time, maybe 4, 5, 6, 7, 8, 9, 10 years, and sold when it got above this line here? So I purchased down here, sold here. Purchased down here, sold up here. Purchased down here, sold up here. Purchased down here, maybe sold, maybe not. Purchased definitely down here, and then wait for it to come back up because I think we're in cycle. Commodity to stock ratio is what I mean by that, in cycle. So I think it's a good opportunity to sit and buy cheap assets. That's how I play it. I'm not here trying to trade all these things in the short term, trying to capture small little market moves. I'm playing the big picture view, and this is one of the cheapest times to buy it. Another inflation asset showing relative strength. This is XLE. XLE, make sure you keep an eye on energy. It's the end of quarter return chasing has potential as it continues to lead, and the majority of people are underexposed. And we're squeezing up, trying to break out here. We are squeezing with a little bit of a support line coming up and a resistance area that we might break out of. If that occurs, I know that we can buy it at basically one of the cheapest times in history. Seems like a pretty good setup here. That's all I'm saying. Everyone in the comments, oh, we're going to get a recession. You just don't understand. Well, I mean, I bought here and literally right at this corner there, not in XLE, but in other smaller companies that went up massively. And I'm going to continue to hold. I think we're in a bull market. And I guess people get mad. I don't know why. XLE versus the S&P 500 is breaking out too. And that's usually when things go ridiculously well. when you get this outperformance, you get money flow into energy. If we get that outperformance, we've got runways for days in this ratio to go up against gold. Runway for days. um, the asymmetry here of oil versus gold is one of the biggest times in history, and you don't want to buy it when it's one of the biggest times in history. Like that just doesn't make sense to me, guys. Sorry, it just doesn't. Either you believe in uranium is on sale and it's a bargain, or you think the trade is over. It all depends on if you have done your supply to demand research. If it was avocados at 10 cents each, would you buy as much as you can? Well, I mean, I love avocados, so yeah, I'd be buying a bunch of avocados at 10 cents. If they're good avocados, I don't want to be buying stuff that's the mushy, the super mush type where they're about to go bad and they're starting to brown out. Yeah, I don't want that. But if they're prime avocados, I'd definitely be eating some avocados at 10 cents each. I believe we're in a uranium bull market. I think it is tied to energy. I think it's tied to the commodity to stock ratio. I think it's tied to money leaving the S&P 500 and NASDAQ and searching for returns. And I think money is going to make its way into uranium. I think that's a bigger deal than the actual supply-demand dynamic. I think supply and demand is great, and I think it is screwed up going out into the future. But I also think money flows are a big deal. And I think money flows are going to rotate at commodities here very soon. So I'm a believer in uranium because of the commodity to stock ratio and the bull market in commodities. A little bit less so than supply demand in the short term for me. Tech and energy have a special relationship of being completely inverse. Historically, when big trends break, it tends to continue for years before reversing. And we're breaking down of COMPQ versus the S&P 500 energy sector index. This breakdown is a big deal. It's money rotation. This also occurred very similarly in 2001. So maybe you could say it's 2004 even, depending on where the fractal location is. But it looks very similar to the breakdown. We broke down in 2022. We climbed up a little bit. Everyone was believing that technology was still the SHIT. But we're breaking down again. This was a bear trap. Sorry to tell you. Maybe it could be similar to this one down here that will eventually run all the way up. But this ratio is a big deal. Money's going to start flowing into energy, perhaps more than, and flow out of the NASDAQ composite. Casper, silver will be the best performing asset over the next 5 to 10 years. My target for the 50-year cup and handle points to 650 USD-ish, with most likely a lot of overperformance. I don't know where it's going to go. Very well could go there. I don't concern myself with price targets that much. Usually a lot of investors say, what's your price target? How high is it going to go? I don't invest like that. What I do is I look at the size of the pattern. I say, oh, it's huge. Size of the pattern is massive. So whatever the projections are going to be, it's going to be a big projection. And then I don't dwell on the price target necessarily. Then I look at how cheap is it historically against itself? Is it cheap against gold? Is it cheap against priced in US dollars? What does the entry point look like? If it's a great entry point and it's super low risk if you're playing the physical silver metal itself, well then yeah, you've got a huge asymmetric setup. And that's all that matters is you have the huge asymmetric setup. No one knows exactly where it's going to go. No one knows what the exact pricing will be. And the projections will all be wrong for the most part. But it's a gigantic pattern. It has huge potential. And I think we could easily go to prices that are triple digits, maybe even to 650 or more. Who knows? So that potential, I'm going to play it. And if it doesn't pan out the way that I think, maybe I just won't make as much money, and that's okay. It's the way it is. But you take your shot when things look best and the asymmetry is the largest. And if you've got big patterns and everything's there to produce a potentially very large move, I'm going to take my bet and go for it. That's what investing's about. A lot of people get mad because someone will make a projection and then it doesn't hit their projection. It's like, well, no one's going to be accurate. All the projections are wrong. You can't get mad at that because you can't predict the markets. Uh, so I don't know what you're getting mad at. You shouldn't get mad at making market projections or predictions. You shouldn't be mad at any of these people because no one's going to get it right. All you can do is you can buy when things are cheap, and we know that silver's cheap, and we know it's got a big pattern. So I put the two and two together, and I've been buying it for a while. So hopefully we get up there, and that's what it is. Here's the correlation between Bitcoin and NASDAQ since 2019. Bitcoin to US dollar looks very linked. So this is Bitcoin priced in US dollars versus the NASDAQ. And it's very linked, NASDAQ and Bitcoin. So if NASDAQ falls, I think Bitcoin will follow with it. And it's more or less just an extension of the NASDAQ and that market condition. The market condition that was very favorable for the NASDAQ from 2009 to say 2024. And now when that rotates and turns, I think Bitcoin's going to go where the NASDAQ goes. That would be my guess. Bitcoin has never went through a different market condition than what we were just in because it was created in that market condition and only lived in that one market condition, which was conducive for the NASDAQ to go up under. So we'll see what happens when it goes through a different market condition here. In the long run, investing is about value and the expectation that eventually price will catch up to that value. But in the short run, it's all about psychology, emotion, and popularity. In the short run, it's capital flows that have the most profound impact of all, says Howard Marks. And that's what I was talking about, capital flows or money flows. Everything over time will hopefully go to what the value of the underlying asset is. If things are underpriced, how do you know something's underpriced? If you price it in dollars, it's hard to understand what's overpriced and underpriced. You have to start to price things of an asset versus an asset to get the dollar denomination out of the way. That's the only way that I can really figure out how to price anything. So if it's all about value, then you have to find a way to figure out what's undervalued or cheap and what's expensive and overvalued. Shabam Garg says liquids production in Norway is starting to fall below forecast and showing a 5% decline in year-over-year barrels supplied. Reminder that every single oil field in the world is subject to base decline rates, with the fields being drilled recently more complex and expensive than ever. I don't think he's got anything yet. So we've got a 5% decline rate in Norway starting to fall there. Now, I don't know where all this oil is coming in the future. I really don't. I'm seeing all these decline rates occur in all these different areas, and I'm like, this is going to start to stack up here pretty big. And then the whole world's going to start to decline in oil, and that's not going to be pretty. The position there is energy, and most likely precious metals are going to do incredibly well. Incredibly well. That's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special coupon code if you'd like to join. We've got the question and answer session loaded to the website if you want to go check it out. And if you've missed it. But that's all I've got. We'll catch you next time. This is Finding Value.